Welcome to the State and County Retirement 101 educational video. This video is designed to provide you with just some basic information about your state and county retirement plan. To begin, let's talk about the retirement office and how to contact us. The Nebraska Public Employees Retirement System, or NPERS, is the state agency that administers both the state and the county retirement plans. We're located in Lincoln. We're at 1526 K Street, Suite 400. We have a call center. If you've got questions about your account, you can give us a call on either of those two numbers. We also have a fax machine if you need to fax something to us, and our website address is listed on that slide. Now, NPERS is not the only entity that works with our retirement plan. There is also a plan record keeper, and the plan record keeper is currently emeritus. The plan record keeper is responsible for tracking account balances of member accounts. If you're in a plan where you can make investment changes, they handle those changes, transfers, distributions from your account, and also the quarterly statements that you receive. But if you have questions about your retirement benefit or your account, you should contact NPERS, not Emeritus, the plan record keeper. This is the main or the home page of NPERS website. Information is available in the form of videos, publications such as newsletters about your retirement plan and the retirement plan benefits. Forms are available also on our website. When we are conducting seminars, the seminar schedules are available on the website along with the seminar enrollment brochures. We also have a link to Emeritus on our website and links to the plan's benefit estimator. Let's talk briefly about the online account access buttons that are available on our website. There are two separate online account accesses that are available to state and county members. NPERS Online or Emeritus, the plan record keeper online. And those are two separate logins, which is why there's two separate buttons on our home page. If you create an NPERS Online account prior to retirement, the main functionality that you have is that you can review the beneficiaries that you've designated for your retirement account. The Emeritus Online access provides you with additional information about your account. It'll show you your account balances. You can access your quarterly statements online. If you're in the retirement plans that allow you to make investment elections, you can do that online, and you can review your investment performance through the Emeritus Online account access. Let's begin talking about the benefits now. Now, the state and the county retirement plans are two separate plans, but the design of the two plans are essentially the same. And we're going to talk primarily in this video about the mandatory retirement plans for state and county members, which are the cash balance plans or the defined contribution plans. We will discuss the voluntary deferred compensation plan in a separate video available on our website. Cash balance, the original Tier 1, was created by the unicameral in 2002. And it went into effect on January 1st, 2003. So if you are a state or county employee hired on or after that date, you are participating in the cash balance plan design. Prior to that date, you would have participated in defined contribution, the older plan. And when cash balance went into effect, the unicameral opened up a window for people who are already participating in the older defined contribution plan to decide if they wanted to keep the defined contribution benefit that they had at that time, or if they wished to convert over and participate in the newer cash balance plan design. At that time, about a third of defined contribution members converted over to the newer cash balance plan. In 2007, another bill was passed by the unicameral that opened up a second one-time window where individuals who were still in the older defined contribution plan could participate by transferring over to cash balance. And in 2012, a third bill was passed by the unicameral that opened up a final window for individuals who are in defined contribution to convert over to cash balance. In 2018, another bill was passed by the unicameral that created a second tier of benefits in cash balance. So as of the time of this video, we do have state and county members participating still in the older defined contribution plan. We have individuals in Tier 1 of cash balance and individuals in Tier 2 of cash balance. Several sections of the plan design are the same. As we go through this video, when we get to the sections that are different, we will point out those differences between those three plans. The contribution rates are the same, whether you're in cash balance or defined contribution, but the contribution rates are different depending on if you're a state or a county plan member. If you are a state plan member, your contribution rate is 4.8% of your gross salary. You contribute that on a pre-tax basis to your account, and your employer, the state, matches that at 156%. If you are a county participant, you contribute 4.5% pre-tax of your gross salary, and the county matches that at 150%. Those contribution rates are set by state statute, and members cannot contribute more or less to their mandatory retirement plans. Let's discuss vesting now. Vesting is a good thing because when you terminate employment, if you are vested, you get to keep the employer match. If you terminate prior to being vested, you do not get the employer match. So how do you vest yourself? Well, there are different ways. Per statute, if you participate in the plans for 3 years, and they count that as 36 months of making contributions into the plan, then you are considered vested. And if you terminate employment, you'll be able to keep the employer match. Statute also stipulates that if you are age 55 or older and participating actively employed by the state or the county, then you are vested. So if an individual is hired on or after age 55, they begin plan participation on a vested status. Members will also be vested if they pass away while actively employed for the state or the county, or if they become disabled while actively employed for the state or the county. Let's talk now about the investments and the rates of return plan members receive on their accounts. This is one of the main differences between the cash balance and the defined contribution plan. So we'll begin with cash balance. If you're participating in the cash balance plan, either Tier 1 or Tier 2, you do not make investment decisions in this plan. Now, the money that you contribute and the matching dollars that your employer contributes to your account, those dollars are invested, but the investments are handled by the Nebraska Investment Council. And the rate of return that individuals receive on their cash balance accounts is not directly tied to the market performance of these investments. The rate of return that is credited to both cash balance Tier 1 and Tier 2 accounts is tied to the federal midterm rate with an additional 1.5% added on top of that. There is also a minimum rate of return if you're participating in the newer cash balance plan, and that minimum rate of return is 5%. So if you're in cash balance, you will never receive less than a 5% guaranteed minimum rate of return, and if the federal midterm rate goes up in the future, you could receive a higher rate of return than 5%. This plan also provides an enhanced annuity rate for individuals who elect to purchase an annuity from the state of Nebraska at retirement. Once you reach retirement age, you'll want to review this because that annuity rate is an integral design of the cash balance plan. It's a pretty big benefit if you're a cash balance member. Cash balance also has the potential to provide dividends for people participating in the plan. As I mentioned, the money in cash balance is invested by the Nebraska Investment Council. Those investment returns are used to provide that guaranteed rate of return for everybody participating in the plan. Every year, the state requires us to do an actuarial study of the plan's funded status. If the actuaries determine that there is adequate money in the plan due to positive investment returns, then the Public Employees Retirement Board can issue a dividend to individuals who are participating in the cash balance plan. Now let's talk about the older defined contribution plan design. This is actually a little bit simpler than the cash balance plan to explain, but it's a more complicated plan to participate in. Primarily because in the older defined contribution plan, you are responsible for making investment decisions. There is no guaranteed rate of return like in the newer cash balance plan. Members in the older defined contribution plan will see their account balances increase or decrease depending on the investment decisions that they have made and market performance during that time. NPERS does provide investment help. Now, we are unable to provide individual investment assistance to our plan members. That's something you need to be licensed to provide to individuals, and we are not licensed to do that. But we are able to provide you with general investment assistance. And the two main vehicles that we use for that are our annual investment report and then our investment education video. And both of those are available on our website. If you are participating in the older defined contribution plan, I strongly encourage you to review this information and make good, informed investment choices with your account. We've talked about the rates of return in your retirement account. Let's discuss now about designating beneficiaries. The beneficiaries that you designate are the individuals who receive any funds remaining in your account upon your death. So it's important to keep these beneficiaries updated because you want to make sure the proper individuals will receive these dollars upon your death. If you're a state employee, we want to make sure that you don't get confused. When you're going through open enrollment, you designate beneficiaries, and these are not beneficiaries for your retirement plan. The beneficiaries that you're designating during open enrollment are for the state's life insurance that's provided to state employees. The only way you can currently designate beneficiaries for your retirement account in both the state and the county plan is by using the NPERS beneficiary designation form. And that form is available from your employer, or you can access it online at our website. To designate your beneficiaries, you need to complete that form, and then you'll have to sign it in front of a notary and have it notarized, and then to mail the original form to our office. And remember, you need to keep these updated. So anytime you have a life event, such as a marriage or a divorce or the birth of a child or the death of an individual who you have listed as a beneficiary, it's always a good idea to fill out a new form, sign it in front of the notary, and submit it to our office. When we receive the new form in our office, it will take precedence over any prior beneficiary designation forms that you have submitted. And remember, if you create an NPERS online account, you can review who you currently have designated for your beneficiaries. When completing the beneficiary designation form, just a couple things to note here. In the upper right-hand corner of the form, you'll see a vertical column of boxes. That's where you designate which plan you're participating in that you want to designate beneficiaries for. Some of you may be participating in both the mandatory and the voluntary deferred compensation plan that the state offers. If you are, you can designate the same beneficiaries using one form for both of those plans by checking both of those boxes. Then after you mark the plan type, you'll put your member name and information there. And then underneath that are the two sections where you designate your primary and your contingent beneficiaries. Now, most individuals, if they are married, generally put their spouse as their primary beneficiary. And if they have children, then they generally put the children in the contingent beneficiary section. Now, how you wish to designate your beneficiaries is entirely up to you. But remember, your primary beneficiaries are the individuals who will receive that death benefit upon your death. Contingent beneficiaries do not receive any death benefits unless all the primary beneficiaries have already predeceased you. A mistake we occasionally see people making is they believe that if they put down 2 primary beneficiaries and then contingent beneficiaries, that if one of the primary beneficiaries passes away, that share will revert down to the contingent beneficiaries. And let me clarify, that is not the way the beneficiary designation form works. In the example that I gave you, where if you have 2 primary beneficiaries, one of those beneficiaries predeceases you, then when you pass away, if you have not submitted a new beneficiary form, that sole remaining primary beneficiary will receive the entire death benefit. Again, to reiterate, contingent beneficiaries only receive a benefit when there are no primary beneficiaries alive at the time of the death of the member. Another thing I want to point out on the form too, when you look down the right-hand side of the form, you'll notice there are percentage marks. So let's say you are listing 2 primary beneficiaries. If you want them to share equally, you would write 50%, 50% in each of those sections. But maybe one of those primary beneficiaries you want to receive a larger percentage of the death benefit. So you could write 70% and 30%. Don't write 90% and 20%. Because that doesn't add up to 100%, and then we're going to have to send the form back to you. So please make sure when you're writing those percentages that it adds up to 100% for each section. Let's talk now about the difference between retirement versus termination. Per state statute, if you cease employment on or after age 55, you're considered retired. But if you terminate employment prior to your 55th birthday, you are considered terminated. Now you have the same distribution options. You can take the money out of the account. There are 2 things that could be important, however. The first is if you're a state employee, if you terminate on or after your 55th birthday, there are additional benefits that you may have as a retiree, including potential continuation of your health insurance if you are carrying it through the state of Nebraska. Now that continuation of your health insurance, if you're a state employee, is handled by the Department of Administrative Services. That is not handled by the retirement office, so you'll need to contact the Department of Administrative Services for information on that continuation of your health insurance. The thing that we can talk about is the tax penalties. If you take your money out prior to reaching retirement age, you may incur what are called early withdrawal penalties. Now you are going to have to pay taxes on the distributions you take from your retirement account because you've been putting the money away on a pre-tax basis. So just get your brain wrapped around the concept that that money is going to be taxable income when you take it, regardless of what age you are. But what you want to avoid is taking it too early and suffering additional early withdrawal penalties. If you terminate employment in the year you turn 55, per the federal tax code, you can take distributions from your state or county retirement plan without early withdrawal penalties. But if you terminate employment prior to reaching the year you turn 55, you need to wait until you've reached age 59 and a half to avoid these early withdrawal penalties. Once you do terminate employment, you can begin taking money from your account, and the distribution options vary depending on if you are participating in the older defined contribution plan or if you're participating in the newer cash balance plan. If you're participating in the older defined contribution plan, your options are you may defer the account, you can begin taking distributions in the form of a lump sum or rollover, you can set up a systematic withdrawal if you're in the older defined contribution plan, you can purchase a monthly annuity from the state of Nebraska or do a combination of all of these options. If you are participating in the newer cash balance plan, there is a restriction on your distribution. In the new cash balance plan, you are limited to a one-time distribution that must include your entire account balance. Now, you do have multiple distribution options, however, that you can pick and choose from. You can purchase a monthly annuity, you can take a lump sum distribution, you can do a rollover, or you can do a combination of those three options. But again, you must take distribution of your full account using those options. You can, however, also defer your account if you're participating in the new cash balance plan. I would like to point out that more information is available on these distribution options in the plan handbook, and those of you who reach age 50 or older can attend one of our pre-retirement seminars or watch our pre-retirement video for more details on these distribution options. Let's talk now about what happens when you terminate your state or county employment. The first thing that will happen is your employer will notify our office. They will submit something that we call a non-contributing member form. We will then send you a letter advising you that we have received notification from your employer that you have terminated employment, and now that you have terminated employment, here are your options that you have with your retirement account. Once you decide to begin taking distributions from your account, then you should contact our office. When you contact us, then we will send you the distribution paperwork. When you receive that paperwork, you'll complete it and return it to our office indicating how you want to take distribution from your account. Please be aware that no distributions may be taken from a state or county retirement account until all contributions have been made and posted to your account by your employer. For this reason, individuals should assume that it will be approximately 60 to 90 days after their termination before they will be able to take the first distribution from their account. And finally, some retirement reminders. After you terminate employment and during your retirement years, first of all, it's very important that you keep your address up to date with the retirement office. We may have important documentation or tax information that we need to send to you every year. So if you move, make sure you notify NPERS of your new address. On our website, there is an address change form that you can utilize for that process. Secondly, be aware of required minimum distributions. It is your responsibility to understand when you must begin taking those distributions, calculating the amount of those distributions, and contacting our office to take those distributions. Failure to take these required minimum distributions may lead to tax penalties, and if you fail to take the distributions for a long enough period of time, it can result in your account being transferred to unclaimed property. And finally, remember to update your beneficiaries as needed. You can use the beneficiary designation form for that on the NPERS website.